Great. Thank you very much, Adrian, and thank you very much, everybody, for joining me today. So let me make this full screen. You see my slides okay? Okay. Actually, bring this may not move. I'm going to share the full desktop. Sorry about the hiccup. Because otherwise there is a freeze. Okay, this will be better. Okay. All right, so thank you so much. So today I'll be talking about the cover interest rate parity. So the very nice thing about this slide is we don't need to worry about this thing, the very thing that Adrian and Hannah have been talking about. We don't need to worry about the spot exchange rate next period. So why is that the case for CIP? Let's start with the basic definition for CIP, which is the first equation on this slide. So imagine we have $1 today, and we can either invest in a risk-free dollar bond for N period. My notation is this Y superscript dollar sign. Or we can exchange that $1 into S units of foreign currency, invest in a foreign currency risk-free rate for N period. So this is my notation for the foreign currency risk-free rate without a dollar sign. Then we know this is how much foreign currency we'll get back with certainty, right? We don't like that. We don't like the next period exchange rate risk. What we can do today is we can sell that amount of foreign currency forward at a predetermined exchange rate that is tradable today. And that is the currency forward rate, right? So it's a simple no arbitrage because there isn't any credit risk by assumption. I assume the risk-free rates are used for both sides, and there isn't any currency risk. So the left-hand side of investing directly in the US risk-free rate has to be exactly equal to the right-hand side of investing in the synthetic dollar interest rate. And that is the covered interest rate parity. And what is this cross-currency basis? It's our industry and academic jargon to refer to deviation from covered interest rate parity. It's a wedge. So you can apply the wedge to the left-hand side or to the right-hand side. Use the convention, we apply the wedge to the right-hand side. So if you write the wedge this particular way, essentially what you have is that the CIP deviation or the cross-currency basis is the difference between two rates. They're $2 rates, but they're different. They're the difference, one is the one is the direct or the cash market dollar interest rate. In this case, it's just the US dollar risk-free rate for N period. And you have the synthetic dollar interest rate by taking a foreign currency interest rate, essentially paying out the market implied forward premium to hedge or to swap that foreign currency interest rate into US dollar. And then you end up with this wedge. So we say the CIP, so let's step aside, not think about convenience yield of treasury or all this complication. Think about in this money market environment, thinking about the risk-free rate facing large global banks. We like to think about the CIP as a textbook, no arbitrage condition. Why? Because whenever you have some sort of wedge, there is opportunity to trade or to arbitrage, right? You want to borrow at the lower rate and investing at a higher rate with currency risk fully hedged, then you can lever up that trade and essentially earn infinite amount of return, okay? So that's the violation of cover interest rate parity, which we think is a violation of textbook no arbitrage. There are many issues that could be involved with this arbitrage, which I will go through some examples, but I want to give you the big pictures. A lot of the things, pretty much everything that have been brought up can be ruled out. So we do think cover interest rate parity is important. The violation is important because it does represent a failure of no arbitrage, okay? So in the next few slides, I'm gonna try to be a bit more concrete to tell you how to calculate the CIP deviation. As you can see, it's not a hard exercise. You can pick your interest rates. There is going to be a choice to be made, but in terms of picking the benchmark money market rates, the deviation you get are not gonna be that different depending on which set of money market rates you pick. All the action, pretty much the majority of the action is coming from this rho or the market implied forward premium. And I'll let you know how to calculate this rho, okay? So to calculate this rho, it depends on two scenarios, whether you are trying to calculate or back out a short-term cross-currency basis that is with maturity less or equal to a year, or longer-term cross-currency basis with maturity beyond 1 year. So in the short-term space, that's what this slide is about. You need to do actual calculation. So you have to go to Bloomberg or DataStream, your favorite FX data vendor. You download the FX spot rate, the forward rate, very importantly, the day counting conventions, if you're interested in calculating very shorted basis, like a week, for instance, or even overnight or tomorrow next or spot next, which is possible, and the various corresponding interest rates. So the general formula for this rho, which conceptually is the annualized difference between the log difference of the forward rate and the spot exchange rate. So that's the conceptual understanding of this rho. But to operationalize it, you have to know what is the forward settlement day. So that's the exact day. Say if I'm buying a 1 week contract on Monday, we know the spot is going to settle with T+2 convention for most currencies. So that's Wednesday. And the 1 week forward that you enter this contract on Monday, it's actually going to mature next Wednesday. So, okay. So therefore T2 refers to next Wednesday and T1 refers to the spot settlement. So that's this Wednesday. And this actual T1 comma T2 gives you the number of calendar days between this Wednesday and next Wednesday, which is 7 days, okay? So as you can see, if you calculate the short dated basis, this is 360 and this is 7, right? So if you get it wrong, say if there's a holiday, it's 8 days or it's 9 days, this annualization factor is going to mess up your calculation dramatically. So I think that's a very important point to keep in mind. If you just want to calculate some benchmark generic 3-month basis, so this is roughly 90 days, this is roughly 4. So this factor doesn't affect your eventual result that much. But again, for very shorted basis, you have to be very careful, okay? So once you get the day count right, you pretty much can calculate this annualized basis. One small footnote here is if you want to think about using the forward market or the FX swap market as a market for global dollar funding, and you want to get the dollar tomorrow, say I want to bet the dollar today and return the dollar tomorrow. So if you want to actually get overnight funding from swap market, it's possible. It's more involved because we know the spot leg actually settles with T+2 convention. So in some way, the spot exchange rate is already a shorted forward. I refer you to this rather long footnote in a recent working paper with Ricardo Correa and Gordon Liao. It's doable. It's just more involved. But for something that's greater than 2 days, this is the general formula you want to look at. Okay? So going back to the question that was raised during Adrian's part, so that was pretty much the forward market, right? Forward allows to hedge currency risk up to a certain maturity. Essentially beyond 1 year, there isn't much liquidity remaining in the forward market. So what do you do if you want to hedge the long-term currency risk, say on a 10-year US Treasury bond from a foreign investor perspective, or I want to hedge like a 10-year euro-denominated corporate bond? This is where the cross-currency swap market is going to help you out in that respect. There is a very important instrument for G10 currency called cross-currency basis swap, which essentially calculates or trades on the valuation difference between a floating US LIBOR and a floating Euribor or floating Yen LIBOR in the other currency. And we show in our Journal of Finance paper 2018 with Jesse Schrager that this cross-currency basis or the quoted number on this cross-currency basis essentially directly gives you the deviation from long-term CIP based on LIBOR or based on interest rate swap rate index to LIBOR. So essentially, if you want to take the bank rates or these interest rate swap rates as your benchmark, you don't need to do any calculation for their CIP deviation once you go up beyond 1 year, because that's a traded instrument. Whatever that's traded at is exactly equal to the LIBOR cross-currency basis. So on Bloomberg, XCCY is your best friend to look up these rates, okay? So if your goal is not only to know what's the LIBOR deviation for the particular tenor, but you actually want to know what's the forward premium for that particular corresponding maturities, what you need to do is you want to combine these LIBOR cross-currency bases between the two currencies with the two plain vanilla interest rate swaps in the respective currency. Okay, so essentially you have a collection of 3 swaps. 2 are the within currency interest rate swaps and 1 cross currency basis swap to get you a synthetic long-term forward premium. That's pretty much analogous in concept to the short-term forward premium we just calculated on the previous slide. Okay, so that's the convention for advanced economy or G10 currencies without capital control. For emerging markets, the collection of these 2 things, so swapping foreign currency fixed rate into foreign currency LIBOR using the foreign currency RIS, and then swapping that foreign currency LIBOR into USD LIBOR. These 2 steps are combined into 1 step. You have this another instrument called non-deliverable swap, say, which allows you to swap Brazilian real fixed rate into USD LIBOR just in 1 shot. And once you have that thing swapped into USD LIBOR, you can then go back to the fixed US dollar, which essentially gives you a long-term Brazilian real and USD dollar long-term forward. Okay, so these things are going to be useful even if you are not in this research for CIP, right? Because that allows you to hedge long-term currency risk. And the nice thing about this slide is you don't have to remember these details. You can look up on my website or just Schrader's website. These data and tickers and updates are made available through generous help by Joanne Im here and also Rick Parity. So I'm really grateful for their wonderful help. I think a lot of researchers have benefited looking up these tickers and actually using these global rates for their own research. Okay. So that's enough on the mechanics. Just quick couple of slides. You already know the picture. Adrian, I think Matteo showed you. Adrian mentioned pretty much CIP held pretty well. The reason I showed you this picture as opposed to the picture in our JF picture is that you can see this recent COVID-induced dollar funding crunch, right? So CIP held pretty well based on LIBOR. It failed during the peak of global financial crisis. It failed again dramatically during the peak of European debt crisis. This period was very interesting because we didn't really have much of a banking sector distress, but we had the full implementation of a Basel III regulatory environment, and CIP also failed miserably. And then we had a recent COVID-induced dollar funding crunch. It's not an issue about LIBOR. You may not like LIBOR. Me personally do not like LIBOR that much either. Post-crisis, LIBOR isn't the risk-free rate benchmark. If anything, the industry and the academic communities have pretty much converged to use, for instance, the OIS rate. So OIS is another interest rate swap. The floating leg is not LIBOR, but the overnight Fed funds rate, okay? So people have used OIS as a risk-free rate proxy, at least when you're in this sort of bank rate space, when you think about what is the risk-free rate, because we don't want to use treasury yield that has convenience, as Hanno has discussed. So OIS has been sort of used as a decent risk-free rate proxy. You pretty much get similar picture, right? So there is persistent failure. And interestingly, in terms of direction, remember the cross-currency basis is defined as the direct dollar interest rate minus the synthetic dollar interest rate. They're largely negative for the majority of the most liquid currencies here, but there are exceptions. For instance, the Australian dollar and New Zealand dollar not plotted here are the most well-known exceptions. So for these high interest rate currencies, we actually have the cross-currency basis is positive, meaning that the direct dollar interest rate is higher than the synthetic dollar interest rates, okay? So if you swap Australian dollar interest rate into US dollar, that rate, at least based on these benchmark rates, turned out to be lower than the corresponding US dollar benchmark, all right? So that's all I want to say in terms of just on the data front and mechanics. Please feel free to jump in if you want to ask questions, because we may not have that much time for Q&A in the end. I will be happy to stay for the first 10, 15 minutes of your lunch hour if you want to have an intellectual lunch. All right, so the next thing is why does CIP matter when we talk so much about it these days? I can broadly summarize at least 3 things that might interest you to try to motivate. There is some merit to study about these objects in greater depth. The first thing has something to do with the external transmission of US monetary policy. The way to look at this figure is there is pretty much one rate prior to the global financial crisis. So what is this rate? That is the Fed funds rate. Okay, so think about US monetary policy makers set the Fed funds rate. That's our monetary policy target rate. It has a spread below the USD LIBOR. Not a surprise. Fed funds is overnight. LIBOR is 3 months. LIBOR has a bit more credit risk because Fed fund only involves unsecured risk on an overnight basis, which is a very minimum, whereas LIBOR involves a bit more, like a 3 months unsecured credit risk of large global banks. And all these other rates, you can barely see them, right? So those are the colored rates. Those are the implied rates from the FX swap market for the given foreign currency. So pre-crisis, the Fed job or the monetary policy maker's job anywhere in this advanced economy was simpler. They set one rate, and then they look into like a pass-through into the benchmark 3 months term funding market. Their job is done. Their dollar funding dashboard only has essentially one spread. That's the LIBOR OIS or LIBOR Fed funds spread, right? Post-crisis, the job is more complex because you start to have a whole constellation of rates implied from the FX swap market, depending on which currency you pick. And they're different, right? So if you look at the Fed funds rates, again, that's the lowest, and then it pass through into this, again, black line, that's the USD LIBOR, and then you have a bunch of other synthetic LIBOR backing out from their own benchmark, and they're generally higher than the USD LIBOR. Again, we discussed the exception is this red line, the Australian dollars can actually go below the LIBOR. So your job is more complex. Why did you care? Of course you care, as many people will show us in the rest of this workshop, that a large part, for instance, of US assets are held by non-US investors, right? So think about the European pension funds or Japanese life insurance companies buying a huge amount of US Treasury and US dollar denominated corporate bonds. So what currency is their liability? It's in yen or in euro respectively. And they will need to hedge their dollar, euro, dollar yen exposure to some extent, even not 100%, say a 50% or 20% hedge ratio is going to generate a huge amount of demand for dollar hedging, which is like dollar funding services. And this is the rate facing by them. An increase in the hedging cost, showing as a spike of these cross-currency basis, is going to likely dampen the demand for dollar-denominated assets. From a US monetary policy perspective, you would care, right? You worry about the fire sale, you worry about all the related financial vulnerability risk, which is why we have the dollar swap line. And they help greatly during, I would say, 3 episodes of large dollar funding crunch we've already experienced since the peak of the GFC. Okay. So that's a good motivation. The second thing you want to care is you want to care about the CIP deviation as a proxy of the shadow cost on the balance sheet constraint, right? Already motivated is the textbook no arbitrage, and I will give you some concrete example. The usual culprits such as credit risk, transaction costs cannot explain away with these arbitrage. And since the arbitrage exists at very, very short horizon, right? If you read my footnote with Gordon and Ricardo, you'll be able to calculate on the overnight CIP deviation, the classical limits to arbitrage argument, like in Schleifer and Vishny in 93, based on the conversion risk, i.e. the hedge fund might go under because before that anomaly corrects by itself. That type of argument does not apply, right? So it's this is a different type of limit to arbitrage that relies on the constraint as opposed to risk. Okay, so that's an important distinction, and therefore we think CIP deviations are very important. It helps us to understand the shadow costs on the balance sheet constraint of financial intermediaries post-crisis. It helps us to further advance this whole literature on intermediary asset pricing. And the third reason that you may also want to care is we like to think about the CIP deviation and the broad dollar strength in general as an overall risk barometer of global capital markets. So CIP deviation, we know, are highly correlated with the broad dollar strength. As you can see from this picture, we see that when the broad dollar is strong, the CIP deviation is wider. So you have this very interesting dollar cycle. So if you read Hanno Lustig and Irvin Krishnamurthy's last year's Jackson Hole remarks, they talk about the global financial cycle essentially as a global dollar cycle. That's pretty much what they mean here. You can see it very cleanly from this picture. It's not up to date. I have a picture. I forgot to post the most up-to-date one. For instance, at the peak of the COVID, that's when this graph was generated, you have a sudden widening of the cross-currency basis. In the meanwhile, you have a rallying, you have a dramatic strength of the US dollar. More recently, the dollar has retraced back to its pre-pandemic level, and the cross-currency basis again went back to their early 2020 level. So there is a very interesting global dollar cycle that is highly correlated with the strength of the dollar. It's correlated with CIP deviation. It's correlated with broader performance of risky assets and financial conditions. Okay, so those are enough for intermediate for motivation. The next thing I want to comment on is the second motivation we discussed, linking CIP deviation with intermediary constraint. And then I'll say a few words about the relationship between CIP deviation and interest rates, and then we will conclude. Okay, so this is the cash flow diagram for you if you want to see how the arbitrage is actually done. So let's take an example of negative cross-currency basis. You know, I want to borrow directly, I want to invest synthetically, right? So I borrow directly from a USD lender, I change that dollar into yen, I lend out to some yen borrowers, and the yen borrower is gonna give me back yen. I don't like that, but I pre-arrange with an FX forward market dealer. The dealer is going to get the yen, give me dollar back at some predetermined forward rate, right? So this cash flow is certain from ex-ante perspective. Of course, I have to repay. So the difference between the cash flow from the dealer versus what I have to repay is the cross-currency basis in absolute value, or your sure arbitrage profits. So to be a critical reader, you have to think about what can go wrong in this diagram. Many things can go wrong. We've thought a lot about them, and sort of since our first paper with Adrian and with Alexandra Tepper, I mean, sort of the common thing that were raised during seminars are as follows. For instance, people do not like LIBOR rates. LIBORs are indicative, they're subject to manipulation. I think the best defense is in the recent work with two former Fed colleagues. We actually use the actual funding rates from CD and CP market and calculate that profits do exist using the actual rates. I think so that's the end of discussion. The second thing is, how about default risk? Okay, so this is thinking about the investing leg. This part is a critique about, can you really borrow at this LIBOR rate? I just told you, yes, you can by looking at banks' actual borrowing costs. The second part is thinking about, once you invest at the yen LIBOR, are you subject to some default risk of the yen LIBOR panel banks? The answer to that is, you don't have to invest in yen LIBOR. You can invest in the repo rate, okay? Then people worry, how about the cost of collateral? In this case, say we can borrow unsecured using CD and CP and then invest securely in the repo rate. In this case, I don't need to have any collateral to begin with. The cost of collateral would not affect the profits of arbitrage. And an even cleaner example is to see actually banks can park money at various central banks, the ECB, the BOJ, and the Fed, and they earn different interest rates. So despite the fact that the ECB and the BOJ pay a negative interest rate on excess reserves on a currency swap basis, those negative rates actually translate into a more attractive rate than the interest at the on reserve paid by the Federal Reserve, okay? And the third critique is, how about counterparty risk? We saw that this cash flow is important. I need to get back money from the dealer in order to make this arbitrage profitable. How about the dealer default on us? So there's no dealer tomorrow. Do not worry, because the FX swaps are already collateralized to the first order to begin with. Remember, I get dollar today as a borrower, but I post foreign currency as a collateral in that sense. Plus, on top of this generic first order collateralization, there's also initial and variation margin required posted in cash to further reduce counterparty risk. So the magnitude of counterparty risk is negligible in these markets. And finally, transaction costs that we can address easily just by taking a very conservative estimates of the half bid ask on every single leg. and still arbitrage profits remain. Okay, so we don't have much time. For instance, you can look up this paper to see what's the actual bank's funding rate. So this is to plot all the wholesale funding outstanding that is borrowed by large global banks in the unsecured markets. Pretty much everything is below the swapped yen rate. So everything pretty much here, except for the blue area, can be considered arbitrage capital for the dollar-yen cross-currency basis. So it's indeed a real arbitrageable opportunity from a global bank's perspective. And this is to say, if you have the patience to do that overnight calculation, you can see the difference between the swapped ECB rate minus the IOER paid by the Fed is shown in the red, and the swapped BOJ deposit rate minus the IOER paid by the Fed is shown in the blue. They're largely positive, on average 25 basis points or 15 basis points for Euro. Okay, so then why do they exist? So this is not about convenience yield. This is not about all these other usual culprits for why arbitrage exists. This is a story about constraint. So I think at this point, we sort of have converged on this view. Balance sheet constraints of the intermediaries limit the size and exposure that can be taken by them to narrow the CIP deviation. So the ongoing work and the future work is going to zoom in on what specific constraints. Right? The dollar funding markets are quite complex. There are different players. Banks, of course, remain at the center of global capital markets, but it's not just banks. There are also other levered investors. There are real money investors, and there are also interesting dynamics you want to understand from the demand side. For instance, the pension fund life insurance story that I just discussed. So I don't think it's closed research. It's very active and ongoing. It's because it involves to understanding many different parts, which is all different. That's why it's a very exciting field to work on. I'm gonna quickly comment on the constraint-facing banks. So the constraint-facing banks are obviously the post-crisis regulatory constraints on the banking sector. So broadly speaking, they fall into two categories. There are constraints on the size of bank balance sheets or in the form of total leverage. For instance, the Basel III leverage ratio requirements require global banks to maintain at least 3% capital against all assets, regardless of their risk characteristics. And global banks also worry and care about this GSIB capital surcharge, where the size of balance sheet is also a very important component of the GSIB score. Okay. So why does size matter for CIP? Of course, if you want to do more CIP arbitrage, you have to borrow more dollars, investing more in yen, either park the money at the BOJ or lend out in the yen repo market. Even though that derivative doesn't show on balance sheet, the actual borrowing and lending show on bank's balance sheet. So doing more CIP translate into a bigger balance sheet, make the leverage ratio or the GSIB surcharge constraint more binding. Okay, so that's the first type of constraint. The second type of constraint is to think about these days, banks have so much extra cash, right, sitting at the Fed. Why can't they just use some of those cash and lend out more in the FX swap markets and then narrow the basis? So in order to see why that cannot happen on a massive scale, we have to have some arguments on the constraint on the composition of balance sheet, even holding the size of balance sheet constant. So more detail on that is discussed in the paper with Gordon Liao and Ricardo Correa. Okay, so we like to think also more generally, the constraints on the banking sectors also have spillover effects on the levered entities, hedge funds in particular, because they borrow from banks. They don't borrow from the commercial bank arm of the banks, but they borrow from GSIB affiliated dealers. For these leverage type of calculation, for instance, JP Morgan would care how much its security dealers are actually lending to hedge funds. Okay, so this is the picture material I already showed you. I don't need to further elaborate, just to say these quarter end effects are there every single quarter. So we probably published the figure up to 2016, but then it was there every single quarter afterwards. So there hasn't been any change effectively. Another supporting argument that one can think about for this CIP proxies for balance sheet constraint is we don't have to zoom in at CIP. We can also look more broadly at some other near arbitrages. This is a collection of other near arbitrages. They're not as clean compared to CIP. Some of them are not exactly equal to zero, even pre-crisis, at least they both reflect some commonality, that is the same global arbitrager broadly defined are operating in all these markets. So what we did in a paper with Ben Bear and Amy Huber is that we take a first principle component of a bunch of other arbitrages, which is shown in blue here. And I'm showing you that they are very correlated with CIP deviation. So they're not perfectly correlated. One way to think about it is each of these markets is subject to their own specific demand side shocks, right? There is some demand for a dollar that is not shared by demand for CDS, not shared by the demand for, say, German bond versus KfW with a federal government-backed agency bond. But the same global arbitrage's balance sheet constraint is the common factor in all markets. Therefore, the commonality in these things suggests, and like large extent that how much this commonality can explain our arbitrage really highlight that all these arbitrages post-crisis do reflect the constraints on the global intermediary. All right. So finally, a couple minutes, I want to highlight a very, very important results in terms of relationship between CIP deviation and interest rates. And the key result is, as you can see in this figure, the cross-currency basis, here I'm plotting LIBOR, you can get the similar results for OIS or for other rates you pick, is positively correlated with the level of the basis. What does this mean? Again, recall the definition of cross-currency basis is that the direct dollar interest rate minus the synthetic dollar interest rate. So this means that the low interest rate currencies, as you can see here, right? Low interest rate in Adrian's portfolio sorting exercise, the Japanese yen, the Swiss franc, actually have highest synthetic dollar interest rate because they have the most negative cross-currency basis, right? So that's what this bullet is saying. Low interest rate currencies have high synthetic dollar interest rate, and on the contrary, high interest rate currencies have low synthetic dollar interest rate. This has a very, very important implications on the direction of trading UIP versus CIP, right? We've learned from Adrian, from Hano, to take advantage of UIP violations, you need to go short in to take advantage of the UIP deviation, of course, you need to go long in high interest rate currencies such as Australian dollar and short in low interest rate currencies such as Japanese yen. Whereas we know on a swap basis, the low interest rate currencies actually have high synthetic dollar interest rate. So take advantage of CIP violations, and arbitrageurs has to go long in low interest rate currencies and short in high interest rate currency. So it's very interesting, they're the opposite. And I think we have some intuition for that, why that were the case. If we think about the client side of demand or the hedge funds, the real money, a lot of people, they're not the typical global bank type of intermediary. So these clients, they want to do the carry trade, they want to collect the UIP. What do the intermediary or these global banks do? They have to take on the other side of the trade. And post-crisis, they have to charge a fee on providing that intermediary service. And therefore, the clients earn the UIP because the clients take the FX risk. The dealers or the global banks earn a CIP because they hedge their risk. Okay, so I think I ran out of time. So let's just conclude. The slides will be posted. You can read them. I want to conclude. This is a very exciting research agenda because there are many, many different players, and this market is very fragile, as we have seen large spikes happen on a periodic and also unexpected basis. And understanding these vulnerabilities requires a deep dive into specific institutions at specific time. So yeah, so I hope there'll be more work on this for us to understand these markets better.
Well,